Good afternoon. This afternoon we're going to talk about LRP, the Livestock Risk Protection Insurance Program that they have producers. We figure being cold outside that it'd be a good time to talk about some of the changes they've made to the program the last year. And we think this is a really good risk management tool to help producers protect their cattle. So we'll get started with it. What is livestock risk protection? It's a risk management tool, a guaranteed price floor for fed cattle, feeder cattle, swine, and lambs. The coverage is from 70% to 100%. The premium for livestock is due at the end of the endorsement. Livestock risk protection can be bought every day, and it's sold between 3 o'clock in the afternoon till 9 o'clock the next day. The reason that it's 3 o'clock is it takes them a little bit of time to get the prices from the markets that day to figure out what the cost is going to be for the producer. LRP, weights covered. For each category, it's a little different. For fed cattle, all types of cattle are included for the fed cattle / live cattle. And you can use a target end weight of 1,000 pounds to 1,400 pounds. When you see the quotes on a lot of this stuff, they'll do everything based off, the CWT, so it'd be 10 to 14 CWT. Feeder cattle by type. You have steers under 600 pounds and steers 600 to 900 pounds. Heifers, dairy cattle, Brahman are the same, and then we also have unborn in those categories under 600 pounds. And then we also have LRP for swine with a target end weight of 1.5 to 2.5 lean weight. The LRP formula, the price discovery, we pretty much use the futures from the CME live cattle, feeder cattle, and lean hogs. So those are every day on the CME, quotes. They're based off the months that you can buy it for, and it's using the CME pricing. The actually ending values is more area specific based on the type of product that you're doing. So for fed cattle, they're using an agricultural marketing service or AMS 5-area weekly weighted average direct slaughter for cattle. They're using the live basis sales for steers 25 to 65% choice. So this is like a cash average that they use. It's a weekly report that comes out. That's used at the end of the report, or end of your endorsement to see whether there's a payment or not. Feeder cattle is based on the CMA feeder cattle reported index, and then there's a price adjustment factor, and that's based on the type and the weight. Maximum head insurable fed cattle and feeder cattle is $12,000 per year, and it's $6,000 per endorsement. And for swine, it's $150,000 a year and $40,000 per endorsement. LRP benefits, it's a guaranteed price, limited basis risk, the cash price is used are better reflective of your actual price received. There's no minimum contract size. You can do from 1 head all the way up to 6,000 on steers. Producer selects periods that fit his or her risk management plan. Then you can also target weight specific. You can do 1,000 pounders, 1,100 pounds, depending on what you want to insure. LRP is a government subsidized insurance policy. LRP, we're going to talk about LRP fed cattle mainly today. Risk management tool, it's flexible on the number of a head that can be covered. The price level is customized to what you want to cover. It's a fixed cost, and that fixed cost is paid at the end of the endorsement. You can use futures and options with it. If you want to talk futures and options programs or strategies, talk to a primate consultant on that. And there are no margin calls on it. And the last thing too is what you sell your cattle for, it doesn't make a difference on what you have them protected. That has no play in it at the end. Contract specs. So it covers cattle slaughtered during a 30 days of endorsement end date. So for each period that there's out there, you have to slaughter the cattle either 30 days before or 30 days after it. The premium paid is on the endorsement numbers, and the indemnity is paid on slaughtered numbers. Keep in mind here, like we said before, the cash price producer received does not affect an indemnity. Grade of animal does not affect an indemnity. And a producer must have slaughter records available for any loss or indemnity. This is the biggest change that got made in the last year, the government subsidies. As you can see, they pay from 55% all the way up to 35% of the premium. Just like crop insurance, as you go to a higher coverage level, the less the government pays. I'm not going to go through each level. It's pretty self-explanatory with the subsidies at each level. The big reason we're looking at this right now is, when you look at a front month live cattle chart, this goes back to 2013. The green lines are up days, the red are down days. The biggest thing is, you look at 130 floor, we have prices that are above that for the first time since, back to 2015, 2016. So we have pretty strong feeder price, feeder cattle or fed cattle prices right now that make this look very attractive. So we're going to get into this a little bit. Hopefully we don't get too confusing on the numbers. So this is an LRP fed cattle quote right here. So this one has two different length weeks endorsements. You can have a 13-week or 17-week endorsements. And the endorsements go all the way up to 1 year. And then the second column here shows the end date. So if you look at the highlighted level here on week effective 13 length, end date is 4/11. So those cattle would have to be slaughtered before 30 days before or 30 days after. When you look at the top one there, the highlighted ones, it's $139.68 expected ending value. Then your coverage level, those highlighted ones, is between 91% and 94%, so they all fall in the same subsidy range. And then the next line will show your coverage price, your cost per head, subsidized per head, the guaranteed per head, and then the premium and the producer premium. Also on this, when you go across the top, it shows the type of fed cattle. We're using a targeted end weight of 1,400 right now, and I'm just showing the rate for just the cost producer premium for one head. We can go in the quotes and we can put in pretty much anything you want to make it look the way you want. As you can see, if you go to the lowest level, and you go like an 89% coverage for a $125, guarantee, it's going to cost you $5 a head. It's a $17.56 guaranteed price. If you go down into the 17-week endorsements, the price does get a little bit more expensive. But you got to remember adding 4 weeks onto it. As the time value goes on, it does get more expensive. Here's just another quick quote. On the top is a 13 target weight end, and on the bottom is a 14 target weight CWT on the end. And this is just going to show you, if you go to the bottom line of each, at a 1,300 pounder, you're getting a $1,813 guarantee for 44. And if you go down to the 1,400 pound, it's a $1,952, guarantee for $47. This is just showing you that, as you go up in weights, the prices do get a little bit more expensive. But at the same point, your value from a 1,300 weight to a 1,400 weight, though, you're really picking up a lot of dollar value guarantee, based off your premium. The LRP fed cattle quote, this is going all the endorsements from 13 to 52 weeks. And they're all about the same coverage, about 94%. The reason I'm showing this is just, the cost producer premium just keeps getting to be more and more as you move on, to the months out. It does show you that your expected ending value does change along those two. Final thoughts. When you look at doing this, to me, there's two different ways you can do it. You can buy higher coverage to try to maximize your profits, or you try to minimize cost to reduce the risk of a loss. So for producers that are just looking for a way to put a floor underneath this thing, when prices go down or we have something that, moves the markets faster than we thought, this just gives us something in place, for us to limit our downside risk on it. For other people, who want to maximize profits, then we got to look at buying a higher dollar coverage. So, it really depends on what your target is or what you're trying to do. The one thing we always recommend is to try to buy at the high end of the subsidy. So like 90 to 95% the same subsidy. You'd want to buy the 94% over the 91%. It just comes down to, and you've watched our insurance ones before, is, when you're spending a premium, if you look at the 13-week, endorsement at 94.11%, you're getting an $1,840 coverage for $14, all right? If you want to go to the highest value where you get a coverage price of $139.46, now you're going up to $1,952 guarantee per head for $47. So really what it comes down to when you're going from one level to the next is, from this example, do you want to spend an extra, what would it be, 47 minus 14, $33, to get an extra $140 or $112 worth of coverage? That really comes down to what your risk is and the things that you're trying to do with it. A couple things that we're trying to do too here on this is, we'll have some helpful tools out there. We'll have some spreadsheets available, to put out there when you're shipping each month, and what your dates are. And then also, we can help you get your costs in there, and your premium per head to know what our profit per head could be. that's what we're really trying to do is, we're trying to help you figure out what your profit per your head is or what your downside risk is. As usual, we went through this pretty quick. Every individual's risk is a little different, how their operations are run a little different. It's pretty easy to run quotes on this stuff, and it's pretty easy to help a producer out if they want to look at it more. This one we went through all the fed cattle stuff. We'll also do one of these on feeder cattle. We'll try to get one down on swine also. As always, I'm Craig. I do all the insurance stuff in the office here. If you have any questions, feel free to email me at the email address on here or give me a call at 262-707-4112. Thanks. Have a great day.